Hello, my name is Valentin Khokhlov. I'm a CFA charter holder and welcome to my investment club. Last time when we were talking about smart betas and semi-active portfolio management, I mentioned about some particular implementation of semi-active portfolio management that I've had experience with when dealing with Islamic Finance, and I promised to tell more about that. And now I fulfill this promise thanks to long holidays we have here in Ukraine, and I would like to congratulate everyone with the Independence Day of Ukraine, and that gave me a chance to prepare today's session. So some words about it. It started in 2013 when one of investment managers here, quite well known, Eric Nyman, he was approached by a hedge fund, a startup hedge fund in Islamic world, founded by Russian-speaking guys, to help them with preparing investment strategies, and Eric asked me to assist him, and I developed some strategies, semi-active portfolio strategies for this startup hedge fund, and that was my experience with Islamic Finance. And probably I will not cover everything in Islamic Finance, only some concepts important for portfolio management and investment management. So the first word I heard about Islamic Finance was haram. I did not know what was haram by that time, but literally it means prohibited. So things that are prohibited under the Sharia, under the Islamic law, lending money for interest. So getting interest for money, it starts with early Middle Ages. Now the world is much more sophisticated, but still there's prohibition on usury has some very long-lasting consequences. Then some other items that are prohibited include pork, include alcohol. Not sure about tobacco, but we included tobacco in prohibited list just to be sure. Then weapons, or more generally companies involved in defense industries, gambling, prostitution. Well, prostitution is nothing to do with stock market basically, but gambling can be generalized into entertainment industries, so probably we did not include Walt Disney stocks into consideration. Then what restrictions we have, speaking of instruments, fixed income instruments, basically bonds, prohibited because they give you interest income, and interest is prohibited basically. So you can say that there are some Islamic bonds called sukuk, but it's a different concept. So they look like bonds, but conceptually they are based on other ways of getting paid. So basically sukuk, well, they're quite limited, or at least they were quite limited in 2013. So bonds and fixed income was area we could not look at. Then derivatives, which is also a complicated topic, because generally they're considered to be prohibited, because it's kind of gambling. You bet on some kind of uncertain outcome. Uh, but there are some kind of Islamic compliant derivatives nowadays, but we were quite limited in our opportunities to even to hedge some risk of the portfolio because standard derivatives like options, futures, even swaps, but swaps that's different. Swaps can be considered as compliant if, in some cases, but in general derivatives were out of consideration as well, and even with stock trading some areas are entirely banned. For example, short selling, because if you sell something you don't own, you need to borrow it, and borrowing includes paying interest, which is prohibited. So short selling is prohibited. And marginal trading, so trading on margin or trading with leverage, is prohibited because in generally you lend some you borrow some money to open positions for larger amount, larger balance that you have of your own funds. So basically you need to compensate for those both amount and pay some interest, which is prohibited. So basically no short selling, no trading on leverage, on margin. And finally, companies need to be sure that companies you invest in, they also do not violate Sharia. So basically they do not conduct business in prohibited areas such as pork or alcohol, or defense or entertainment. Then they have moderate or small amount of debt financing. So debt is smaller part of the capital structure, and they do not get substantial income from prohibited sources, again, such as interest income, which is against Sharia. So basically, we did not screen companies ourselves, so we relied on some external screening, considering the fact that we are not experts in Sharia. We literally knew nothing about it, but we relied upon the existing Islamic screeners. And even if you read the Dow Jones Islamic Index description, you can find some clues how they do it, how they screen on based on the amount of debt or based on the sources of financial income. So that's something you can get from external sources more knowledgeable of this issue. So now let's consider some kind of possible strategies. So of course it's always possible to use passive strategy, which is investing into Islamic index, which on Yahoo Finance is called IMUS. US is basically United States stocks, mostly large cap stocks of companies that pass the Islamic screening. So basically Sharia compliant companies. Of course, now we have different indices, and probably not only US market, but by that time it was the only choice. And it was a possible way, but there's no reason to establish a hedge fund that invests into Islamic index. It's basically stupid. So that fund was focused on active portfolio management, of course, and what's possible to do with active portfolio management, to invest into stocks, commodities, real estate. So we we exclude fixed income. we exclude derivatives. We could possibly add some alternative investments here, but that fund was focused on stocks, on some investment ideas its founders had by that time, and of course the stocks were run through an Islamic screener, and of course no short positions and no leverage, no margin available. And what I suggested by that time is to consider also a semi-active portfolio strategy, which included basically core and satellite parts of the portfolio, which was under the core satellite model of semi-active portfolio management. And a few words about concepts related but not identical. So core satellite portfolio management model means that the portfolio is split into two parts that are managed differently. Core is passively managed, it has low risk, it's pretty much stable, and basically we put money into some kind of stable vehicle like index fund or something like that, and we get our most part of our risk exposure to our benchmark, to Islamic index in this case. And satellite is active, and it has actively managed, and it has high risk, and that's the way to generate some additional alpha, some additional return by taking additional risks. Another concept, pretty much not related, well, somehow related, but it's called market neutral portfolio, and it involves having some combination of long and short positions, or some combination of assets and derivatives that effectively gets a near zero beta, so near zero systematic risks. The risk, which means the portfolio does not depend on the movement of the market, but on the other hand, this portfolio has some positive alpha, which means it generates some return, and it's called absolute return because this return does not depend on the market, so it's absolute and not relates to the movement of the market, to market return. So basically market neutral concept, as you can see from this description, is almost impossible for Islamic finance because you cannot have short positions and you cannot use derivatives. So as it is formulated here, it's something we cannot use as it is, at least. And the third concept is alpha-beta separation, which may sound pretty much similar, but it's not. It's a view from a different angle, basically. So under alpha-beta separation, we use one set of investment vehicles to get exposure to systematic risk, to get some beta, and another set of investment vehicles to generate absolute return, to generate alpha. And this another set of investment vehicles, they basically should have a near zero systematic risk, so they generate some alpha without adding some exposure to beta. Basically use one vehicle, for example index fund, to generate beta, and to use some market neutral portfolio or satellite to generate alpha. And you see here that it sounds pretty much similar to core satellite, because you have passively managed satellite which generates exposure to the market or to the Islamic index, which is beta generation, and you have another part which may be market neutral, even zero weight total weight is zero because you have long and short positions, and you generate alpha if you choose stocks for long positions that outperform the market and short positions that underperform the market. So basically you generate an absolute return alpha from getting risk exposure to the market, which is better. So basically alpha beta separation can be implemented using core satellite model, but they are not the same. It probably can be generated, it can be implemented in a different way, or core satellite does not mandatory leads to having beta in core and alpha in satellite, maybe different as well, but there's natural relation of alpha beta separation concept with core satellite model, and for satellite it's often but not always it's natural to use market neutral or some kind of similar concept to have alpha generation without adding systematic risk exposure in this satellite. So it was a bit of theory. Now let's see how it was implemented under that particular case. So for selecting companies we used Islamic Finance app. Basically a screener, maybe it was not just a screener, but we were interested only in screening capabilities. So the app that helped us choose the companies compliant with the Sharia. And then for the core part of this core satellite portfolio, we used a portfolio that tracked IMUS index. A simpler way would be to use ETF that follows this index, but at least in 2013 I was not aware of such an ETF. I'm not sure, nowadays maybe some ETFs exist that track Islamic indices, but by that time we did not have one, or did not know about it. So I developed a tracking error volatility TEV minimization model, which I will speak about in a few minutes. And for the satellite we use a standard Markowitz mean variance optimization model. So it's active management, not included stock picking, it included mathematical optimization, so risk return optimization, but still it was kind of actively managed strategy, active management strategy, and then we combined these two parts. The easier way was to just append the satellite to the core, just to simply add them. But a more tricky way was to use some kind of blend or overlay. So we could use long position in the core to offset some short positions in the satellite. So we were able to introduce short positions in the satellite, which in pure Islamic finance it's prohibited, of course. But as we already have some exposure to assets in the core, we can use this exposure to offset short positions in the satellite, so that in our entire portfolio there are no short positions, and the entire portfolio is Islamic finance compliant. How it looks. If you want just to append, you set some weights on core, on satellite, for example 80% core, 20% satellite. So core is 4 times larger than the satellite, and you just put satellite on top of the core. But for overlay, you could, for example, you already have 80% of your portfolio in the core, and you know weights of assets in the core. So you can open, for example, 30% of long positions in the satellite, which should be offset by 10% of short positions. And you can open those 10% of short positions because you already have 80% in the core. So of course you need to check each individual asset. So you can open short position in a satellite only to the limit of the long position you already have in the core. But still you can open them, and for example you can open them up to 10%, so you can open long position up to 30%, and the total would be 20%. So, and those 10% of short positions, they kind of overlay your asset allocation in the core. So that's basically the idea of this overlay. So the models for the core, we need first to calculate asset betas with respect to the selected Islamic index, which is simple. You use a regression model, you know the return on the index, you know the return on the assets, you run the regression, you get the slope coefficient, which is beta with respect to the Islamic index. And then you use the TEV minimization model. So basically TEV formula is known. In my papers I show how using this formula you can derive this objective function that you see on this screen. So you have here the weights of the assets, you have the covariance, then you have sigma b, which is the standard deviation of the Islamic index or the benchmark. So B means benchmark, so it's the standard deviation of the benchmark, and betas with respect to the benchmark, in our case the Islamic index. Then the constraint that the asset weights sum up to 1, and the constraints on individual asset weights, generally they should be from 0 to 1. The standard, the standard limits, and to use quadratic optimization to get the optimal solution for this model. So it's simple. So now the model for the satellite, which is a standard Markowitz model. We need to set risk tolerance parameter for this model, RT. Then we use mean variance optimization with a standard objective function. So here we have the expected return on the portfolio, mu is expected return on the individual asset. RT is risk tolerance. Here we have the risk of the portfolio, weights and covariance. Then the weights sum up to 1. And you have also limits on the individual asset weights, and here please note the lower boundary of the individual asset weights. If you need only long positions in the satellite, you set this boundary to 0, so the lower bound is 0. But if you allow short positions in the satellite, you can set a negative lower bound, but you need to use this formula because you already know the weight of this asset in core, and you know this lambda, which is the ratio of core to satellite. In our case, 80% core to 20% satellite is 4, so you can have the negative weight in the satellite as much as 4 times the weight in the core. That's the lower boundary of individual asset weight in the satellite, and therefore you just blend this negative weight in the satellite with positive allocation in the core. And then you run the quadratic optimization and you get the weights in the satellite. Then you combine it, very simple, just sum up core and satellite for each asset, Then you choose a rebalancing frequency, monthly, quarterly. I used monthly rebalancing, and I faced some issues transaction costs. Why? Because I use this monthly rebalancing as my standard way for individual investors' portfolios, for high net worth individuals, but their portfolios were not very large, and with this hedge fund I did not know the amount they intended to put into this fund. So I calculated the strategies per 1 million invested into the fund, and even 1 million of course was higher than typical portfolio for individual. And when I checked rebalancing using this model, transaction costs were kind of significant in my perception, and the worst situation occurred. For those of you who had some experience with mean variance optimization, you know that 1 month you can get one asset allocation, then next month you get different asset allocation, and the third month you get some kind of reversion. So you get some assets that you have just get rid of in the previous month, and the portfolio can pretty much balance or switch from one allocation to another, and in subsequent months switch back or partially switch back. So basically I saw it as kind of stupid transaction costs that I constantly selling and buying the same assets. And I checked how we can smooth it to reduce transaction costs. So smoothing basically has no theoretical justification, and the idea is purely practical, empirical. You use delta smoothing parameter. Delta is the weight of an asset from the previous period, t minus 1, and 1 minus delta is the coefficient you use for the weight generated with the model. So basically, if delta is 0, you use only the weight the model gives you. If the delta is 0.5, you use 50% of the weight the model gave you, and 50% of the weight from the previous months. So you kind of smooth the model results with what you already have in the portfolio. So I checked two different options, but let's start with how I composed those portfolios. So I took 28 US large cap stocks after the Islamic screener. So they are given here Apple and so on up to Exxon Mobil. So basically 28 large cap stock, pretty well known. All companies are well known. They are for core, and for the satellite I took only 10 of those: Apple, Chevron, Google, Johnson & Johnson, Nike, Pepsi, Pfizer, Procter & Gamble, UPS, and ExxonMobil. And then I checked on 4 portfolios. All of them have 80% core and 20% satellite. 20% means sum of long and short positions. And portfolio P0 was long only satellite and no smoothing, so delta is 0. P1 long only satellite but smoothing factor 0.5. P2 is a satellite with short positions and no smoothing. and P3 is satellite with short positions and smoothing factor 0.5. So as I did not know how the smoothing will end up, so kind of like strange addition. So I checked for like variance, and here you see the results on the 3 years horizon with monthly rebalancing. First column is Islamic Index, IMUS, and then for portfolios P0, P1, P2, P3. You see all those portfolios during this 3 years horizon, they generate all the returns, standard deviations, and so on. They are annualized here. So the annual return you see is higher than the return on the index. They are not very different between the portfolios. You see only that P2 has slightly higher return at the satellite with short positions and no smoothing. If you add smoothing, you see there is no difference in return if we have long only satellite and satellite with short positions. In terms of risk, when we add short positions, we increase risk, which is expected. We increase alpha, of course, for those portfolios with short positions here, but that the expected outcome, because we add short positions to generate some additional alpha. Betas are slightly lower for portfolios with short positions, but the difference is not very significant. So the betas 0.24, 0.23 in case of long only satellite, and 0.91 for satellite with short positions, which is not a big deal. Sharp ratio, very narrow band of values here. Tracking error volatility, which is important for tracking portfolios, and you see that's an interesting fact here. You see when we add smoothing factor 0.5, the TEV becomes lower and significantly lower. Not critical difference, but still you can see there's a difference, at least we can observe, and it's persistent. So for long only satellite, for satellite with short positions, we see the difference. We add smoothing, we reduce tracking error volatility, and we also reduce standard deviation. So basically smoothing here acts as some kind of a technique to reduce risk, especially tracking risk. But that's for those 3 years after the inception of those strategies. I don't have here the generated results after September 2016, but I still follow those model portfolios, and it was an interesting fact that after 2016, in the upcoming years, the performance of long only satellite portfolio and satellite with short positions, they kind of flipped. So the long only satellite portfolio performed better in 2017, better in 2018, and what is interesting, the cumulative return up to this moment for the long only satellite portfolio, I mean the portfolio with long only satellite, it's better than for the portfolio in which the satellite has short positions up to this moment, which is kind of strange or unexpected, and I don't have any good explanation, but my guess is that if you use some kind of active management strategy with short positions, especially, you need to take care of it. Because I developed this strategy in 2013 and I did not change it afterwards. So it's been a long time basically, and probably you cannot just develop a strategy and forget about it and consider that it will reiterate itself without any change, any alteration. So I think that was the main cause. I should have redeveloped this active strategy periodically if I was to expect the higher returns and better performance on portfolios with short positions in the satellite, which are much more actively managed than long-only satellite. So basically that's my guess. I don't know how it would be on different portfolios and different strategies, but in this case the results were such as you see. So and here you see this chart with cumulative portfolio return from the inception, from September 2013 and to the end of August 2016. So basically you see the end result, the blue line, which is a portfolio that has short positions in the satellite. It appears to be better, slightly better, and the red line, which is a portfolio with long-only satellite, and the black line, thin line, is the Islamic index. So basically the portfolio with short positions in the satellite outperformed the portfolio with long-only satellite kind of marginally, and during some periods early in like 2013, 2014, you see the red line above the blue line, and even in some periods the index performed better than either of my portfolios. And the most part of this cumulative return was generated in 2015. So some situation on the market with this active part of the portfolio started to outperform the index, and the portfolio started to have positive delta with the index return, so the positive difference which remained here and which increased in 2016. So it was kind of interesting observation, but after that I don't have the chart. I did not build it afterwards. So that's basically about the theory and some kind of practical implementation of this core satellite semi-active portfolio management in case of Islamic Finance hedge fund. I hope it was useful, and thank you for watching the investment club, and stay tuned, and in the next issues of the investment club speak about different topics. I think I will tell something about my recent research in the field of risk management that relates to value at risk, conditional value at risk, and also maybe we'll speak about fixed income portfolio management, at least some basics and some kind of approaches, because I'm not a very profound specialist in fixed income portfolio management, so only some basics and some personal experience with adding bonds into my portfolio. So thank you for your attention. Have a good evening and goodbye.